For the last couple of years, the big story in the U.S. economy has all been about the resilient American consumer, just spending no matter what. But lately, the signals are they're getting weird. The data's telling us one thing, but how people are actually feeling seems to be telling us something completely different. So let's try and make sense of this puzzle.
And this is the big mystery we're diving into. On the one hand, you've got spending hitting all-time highs. But on the other, consumer confidence is down in the dumps, at levels that usually scream recession. I mean, those two things just can't coexist forever, right? So, which one is telling the real story?
All right, so to kick things off, let's look at the hard data that has so many people feeling optimistic. The latest retail sales report. And at first glance, it looks like a total blockbuster. So in August, retail sales jumped a whopping 0.6% in just 1 month, which, by the way, totally blew past what economists were expecting. On the surface, that makes it look like the consumer spending engine is just humming along. But, and this is a big but, is that the whole story?
Okay, but this is where the plot thickens. That big sales number is what they call nominal. It doesn't factor in inflation. And since prices also went up about 0.3% in August, the real growth, the actual amount of stuff people bought, was only about half that. So think about it like this. We're not actually buying more stuff. We're just shelling out more money for the same amount of stuff. It's like an inflation mirage.
And, if you peel back another layer and look at where people are actually spending, the story gets even clearer. The big winners, online shopping, going out to eat, and buying clothes. But check out the weak spots. Big, expensive items like furniture are way down. So what does that tell us? It seems like people are all about experiences and online shopping while pulling way back on those big, expensive home purchases. So that super strong headline number? It starts to look a little shaky when you ask a really simple question. Where is all this money coming from? Because when we start digging into the consumer's personal balance sheet, that's when you start to see some pretty serious cracks. And wow, this slide right here, this lays the problem bare. Spending is growing nearly twice as fast as people's incomes. You don't have to be an economist to know that's just not sustainable. Simple math, right? If your spending outpaces your income, you've got to be getting that extra cash from somewhere.
Well, one of those places is savings. The personal savings rate has now dropped for 4 months in a row, down to just 4.6%. It seems like people are basically burning through their cash reserves just to keep up with these high prices.
And the other place that money's coming from? You guessed it, debt. Total household debt has skyrocketed to a mind-boggling $18.39 trillion. We're talking credit cards and auto loans piling up at a record pace. Look, this isn't a picture of a healthy, strong consumer. This is a picture of a consumer under a lot of strain.
And this is where the hard data just smacks right into how people are actually feeling. The Conference Board's Expectations Index, which is all about how people feel about the future, has been below this critical level of 80 since February. That reading has been flashing a bright red recession warning, and it's been doing that for months, but everyone's kind of ignored it because, hey, the spending numbers looked great.
So how on earth do we square this circle? High spending, but terrible feelings? The answer is realizing we're not talking about one American consumer. We're talking about two.
Okay, so first up, you have the affluent consumer. Thanks to booming stock and housing markets, household net worth has hit a new record of $163.8 trillion. This creates what's called the wealth effect. Basically, when your stocks in your house are worth a ton, you feel richer and you spend more freely.
And this all leads to a phenomenon that economists are calling the K-shaped consumer. Just picture the letter K, right? One line shoots up, and the other one slopes down. That's what's happening. The financial lives of the wealthy are soaring, while many others are struggling. And that huge gap is what's messing with all the national data, making it look stronger than it really is for a lot of people.
Yeah, and this slide just lays out that divide perfectly. You've got the affluent group riding high on their assets, and they're the ones driving those strong headline spending numbers. But then you have the strained consumer who's getting absolutely squeezed by inflation, falling behind on their bills, and cutting back on anything that isn't essential. But if you need just one number, one statistic to show you how serious this strain is, this is it. The rate of people being 60 days late on their car payments has hit 1.31%. Let me say that again. That is higher than the absolute peak we hit back in the Great Recession of 2009. This is not a drill. This is a 5-alarm fire for a huge part of the economy.
So you can imagine, this whole K-shaped thing is a complete nightmare for the Federal Reserve. Their job is to manage the economy for everybody. But I mean, how do you set one policy for an entire country when one half is booming and the other half is basically buckling under the pressure? It's an impossible tightrope walk. The job market is cooling down, which suggests they should cut interest rates to help people out, but inflation is still way too high, largely thanks to all that spending at the top end, which argues for keeping rates high. They are well and truly stuck between a rock and a hard place.
This table really just sums up the whole conflict, doesn't it? You've got job growth slowing to a crawl, and that's just screaming, hey, cut rates, help us out. But then, strong retail sales and sticky inflation are screaming, whoa, not so fast, don't you dare. This is exactly why the Fed has been so cautious, and why they've had to do this weird hawkish cut, where they lower rates a tiny bit but talk really tough about inflation to keep everyone calm.
Okay, so with all these conflicting signals and this crazy complicated picture, the big question is, what happens next? And really, it all comes down to which side of that K gives out first.
So, what are the odds? Well, the consensus, for what it's worth, is a soft landing. About a 60% chance that things just kind of cool down gently without a big crash. But, and this is a big but, look at that other chunk. There's a 35% chance of what's called a consumer retrenchment. That's where the strained consumer finally just hits a wall and spending craters.
And obviously, each of these scenarios means something totally different for your strategy. A soft landing, you probably want a nice balanced portfolio. But if we get that retrenchment, that probably means you want to shift into more defensive assets. Things people have to buy no matter what, like groceries and healthcare. The main point here is that the risk of things going south is very real, and you just can't afford to ignore it.
For years, the #1 rule has been simple. Never, ever bet against the American consumer. Their resilience has been the bedrock of the economy. But what we're seeing now is that this legendary resilience, well, it's being powered by fumes. It's running on dwindling savings and record-breaking debt, all while the stress builds just beneath the surface. So the real question we have to ask ourselves is, are we watching the final chapter of that story?